Now, before we go into the specific products, we like to look at things in an aggregate and look at kind of where we sit versus historics. And you can see here that, when you look versus last week, when you add up gasoline, jet, distillate, and residual, we had a total demand of 14.75 million versus last week's 15.785. So about a million barrel a day decline, which when you see the big spike up, now the big spike down, and that's why it's important to look at that 4-week rolling average, which we think is going to continue to be just below where we were in 2017, but still following kind of that seasonal trend where we're coming into a low point, you get some of that increase, and then that increase in demand is going to be driven based on distillate, as we've been talking about when you look at some of the underlying flows. Now, that is going to be some of the bigger sides of where does some of this movement go as headlines continue to come out with slower Angolan sales, as well as Congo, or when you look at some of these different flow, there's a lot of pressure that remains in that physical market in terms of some of the difficulties in getting some of those movement. It's really because we still don't have those quotas from the teapots. So on the crude side, we have that one piece, and then when you look at what is happening here, just below that normal average, if you will, of 17, 18, 19, but still not by a lot. We still have jet fuel that's lagging, that'll remain, and that gasoline that is either right at seasonal norms, just below seasonal norms, and then when you look at distillate, that's going to continue to be above seasonal averages, which is going to, again, be that bright spot. So then when we look at where we are on the distillate side, you can see that we had a small build of 3,000 barrels. But one of the things that I want to call your attention to is that 5-year average. Now, 5-year average, so in total, we're 13.1 million barrels below the 5-year average. But when you look at Pad 1 is 13.3 million below the 5-year average. Pad 2 is 500,000 above. Pad 3 is 100,000 below. Pad 4, 300,000 below. Pad 2, 200,000 above. So you're looking at kind of where we sit right now, and you're seeing this elevated amount of product just sitting there, and that's in some locations. Some locations are normal, and then when you look at Pad 1, we are well below where we're supposed to be, which is a much bigger problem when you think about where do we consume a lot of heating oil in the Northeast, and this is where there's going to be some of that movement of at what price do we get some of this acceleration into Pad 1. So when we look at just what are some of the components, so production of gasoline was up a beat, just to about up by about 1.83%, and it's the total volume of gasoline production was down, but when you're looking at what was being targeted, you had an increase of 1.83% gasoline, and you had another increase in distillate of about 89 basis points. Now, remember, there's that bellwether of when I make diesel, I also make gasoline, and you're going to see distillate. You're going to see that targeted the most, which is going to keep this fairly flat, even as demand continues to remain strong, which again is going to push us sideways, and it just makes the comps easier. But still, you're going to see that it's essentially this competition on demand versus supply, especially as imports are priced to come into our market. We had a small decline of 102,000 barrels a day, but Pad 1 was still taking in 62,000 barrels a day over the 5-year average. That will continue just given where the arbitrage is and where the movement is coming from Europe into the U.S. markets. So again, those are going to be things that will be essentially this competition as we come into a lull, if you will, from the heating side. You don't really need it as much. And then what does that look like as we progress through winter? So then when you look at products demand, the supplied, it was just below the 5-year average, but we still say we're going to again, that bouncing up and down, it'll still be elevated. It'll still average above the 5-year average, just because we still have that diesel consumption on the trucking side. Trucking had a small decline when you look at that trucking demand, but we expect to see that increase. As we were talking on Twitter yesterday, they made a deal to have some of these ports operate 24/7, especially on the West Coast. That would allow, again, a bigger inflow and just moving some of these boats in these containers. That's going to call more demand from the trucking side. It's going to call more demand for the rail side. The problem is trucking is going to be able to meet that demand a bit more. There's still congestion on lines. There's still labor issues, and there still is some of that chassis shortage that we talked about. It is better than it was, but it's still an underlying problem, which is just going to limit how quickly they're going to be able to respond to the inflow of containers coming off the water. The other issue is when you look at rates. So rates have actually dipped a bit, but this is coming at the same time that diesel prices are up another 10 cents. So you still have hourly wages at a high. You're getting sign-on bonuses. You're getting other bonuses. Now, how is that going to be weighed with diesel prices going up? So how much margin are some of these trucking companies going to lose in terms of what they're unable to pass on? But again, we still think that we're going to see that demand go back to the highs that we saw a few weeks ago. Now, this is what we were talking about with some of the rail traffic. So the intermodal continues to be below where we were in 2020. 2020 is a tough comp just because it was elevated, but you're seeing some of those headwinds persist, especially in the motor vehicle side. That won't be changing. Grains is going to slowly increase as we come to the end of harvest. And then when you look at coal will remain elevated. The petroleum products is one that should start to see some of those movements, especially as Pad 3 distillate continues to see builds. As Pad 1 sees draws, that'll pull more into the northeast. But in general, we expect to see intermodal not able to kind of climb that ladder. I think the Cass Index did a great job of really highlighting some of the issues and how they're not going to really be able to. They'll close some of this gap. I'm not saying they won't. It won't be 7.8% below on an intermodal side, but about 3 to 4% below. But you're going to kind of hit that wall as we go forward. Then when you look at some of the containers out there, you can see it's just funny because when you look at previous week, previous year, it just continues to stack up. You're starting to see some of the slowdown on the back end, but that is going to remain elevated as we go into the next few weeks, and again as these ships continue to show up. And then when we look at Fortes, Total bought Fortes at lower price than previous day and sought more cargoes. So we're still seeing some of these price discounts come through the system. Then when we look at temperature, you can see temperature is just slightly above normal, so nothing too crazy one way or the other. It's just going to promote really no heating, no cooling, and really start to see some of these reductions on the electricity side as well as the consumption of products. Gasoline had a small draw of 1.96 million, and that's after a fairly sizable draw last week. You can see that it's still kind of that counter seasonal. We're starting to peak, and you can see through using that 29-year average, we typically see some decline as we go through November, and then we start to see some of that acceleration as we go through the end of November into December. Here is where we continue to see builds. We think builds are going to continue, again, taking us closer to the top. We don't think we set a new seasonal adjusted record on storage at all. It's just we're getting to this elevated level, and the comps are getting easier as we've been talking about. So we're only 3.6 million below the 5-year average, and that is being driven by Pad 1 and Pad 2, with Pad 3 about 2.5 million above the 5-year average. So again, there's going to be, and then Pad 5, 1.2 million above the 5-year average. So here we expect to see some steady builds. Again, just getting back to the high that we had from last week, nothing too crazy. Some of that will be offset. So again, we don't expect a huge build, just kind of steady, smaller builds, because those imports are going to remain a bit lackluster. So we had a drop of 543,000 barrels a day. So this is just offsetting. So we didn't think we were going to go to 1.087 million barrels a day. We thought we were going to be at about 800. So now we kind of get this big overshoot to the downside. And it was driven by Pad 1 that saw a decline of 410,000 barrels a day into Pad 1. And again, that'll stabilize. We expect that to kind of flatline right at these levels. We expect Pad 5 to see a little bit of an increase, which again is just going to keep us right in line with where we normally are for this time of year. But given the shift in the way refiners are going to target, we expect to see some of this, again, some of these increases. Now, we could see declines as well, just because we are seeing that maintenance come down. I just think that we're flatlining here, and we will get enough imports, which again is just going to keep us just small builds, not huge, not like we had last week, but a build close to 800,000 to 1 million versus some of these swings that we've seen over the last few days. The last few weeks. So when you look at gasoline demand continued to diminish. According to Gas Buddy weekly Sunday to Sunday data, gasoline demand fell 1.7% to its lowest since the week of May 30th, and it's the second straight week of declines. And again, that's very seasonal. If you think about end of May, in October, you see that seasonal decline as we come out of that peak that we have for summer driving. We think it continues to come down a little bit, but remember we were saying that we're just going to kind of suck around these levels of about 8.9 million, 9.1 million of demand and just bounce back and forth within this tight range. Some of it will be a bit above seasonal, some of it will be below, but again, the average is what we're saying is going to be just below that 17 to 19 average. And here's one of the bigger driving reasons, or lack of driving reasons. When you look at gasoline prices, so we had another increase in gasoline, up almost 8 cents to $3.20, almost 27 cents. That we see that continuing to go up, and that is going to be a much bigger overhang as that filters through the system. And you're seeing, and we'll talk about in the Econ show, how real wages continue to fall. And it's really being the overhang being these increases in wages not keeping up with it. It takes time to see this move through. This isn't like you snap your fingers and it's like people are going to get gas and see the price and go, oh, well, I'm not going to get gas today. They'll still get gas, but they're going to adjust a bit how they consume that gas tank. And then when you look at blending components, which we keep talking about, blending components keep building, which is also signifies that people are going down the grade scale in terms of premium, mid-grade, and then regular. And that's where you're seeing more people shift to the regular if your car can handle it. If it can't, we've had these debates with Paul Sankey, but we will leave that for another day on if you should get premium or not. So then you look at diesel prices, and this is what bites the most. And when you look at what is happening so far on the diesel side, which it went up another 11 cents to $3.59, and that's where the competition will remain white hot between trucking demand and what is it going to be for heating oil, because it's very similar in terms of grades. Now, some have said that, well, demand was fairly stable during COVID. And when you're locked at home, you're going to try to get out and drive. And when you look versus a year ago, gasoline was $1.10 cheaper. And that just made it a bit easier to go out and say, okay, well, I'm going to go get gas at $2.10 versus $3.26. So again, you're starting to butt up against where, do I really need to go here? Can I hold off? And these are going to be some of the difficulty as prices, as we keep talking about going higher, as they're already at $3.30, according to Gas Buddy. Because remember, this is October 11th. We're on October 14th. So they're already up another 3 cents. And the week isn't even done yet. So again, these are the pressure points that will continue to come down to the consumer and make them change course. Now, will it make them change course today, tomorrow, or when they get their winter heating bill? And that's when I think the sticker shock is really, you're going to see that bigger drop off as people look at their heating and like, wait. It costs me how much to heat my home? And gasoline is how much? And that's when I think you can get a lot of this, let's call it demand decline, demand adjustments that will accelerate, and it's going to be mixed with where they get that first bill on delivery, given where diesel prices are in heating oil. So this is when we look at blending components. So when just talking through blending components, it was a small decline of 650,000 barrels, which is where I think you're going to see some of that gasoline movements are. And that's 4 million above the 5-year average. And you can see it is just above the only time it was higher was in 2018. And just given that demand cycle, we think that will set a new seasonally adjusted high, because we're going to see it just go sideways and the comps get easier, which again is going to push us into this elevated level. Now, when we look at the 15-year demand average, we're above that 15-year average. You can see it's moving fairly in line with where we were seasonally off the top of the chart. Little bit of an acceleration to the downside, but remember, we thought it was too high last time, so now the acceleration to the downside, a bit of a makeup. So then when you look at it against the 5-year average, the last 5 years, you can see 2016 was lower, but we're right where we were in 2018 as well as 2017, and then well below the elevated points as we went through 2019. So that's some of those shifts in general. We think that there's going to be one more dip down, not to the low that we saw in 2016, but again, you're going to see a bit of a dip just below kind of where you normally see some of these increases. We just think that it'll again come down and then stay a bit muted. It's just you're going to have to average it out because you have this ebb and flow, but we think it's just going to be just below where we were in that 18 and 17 level. Not so much the low of 16, not so much the high of 19, but again, kind of sitting within this steady state. And here's why, when you look at what's actively happening in the market, transit stations have flatlined, workplace movements have flatlined, retail, recreation, everything is kind of just bumping along either the bottom. And this comes back to what we're talking about of weekday, weekend. Weekday is going to continue to be weaker, weekend will be stronger, and that will average out to something just below what is normal. When you look versus last year, you can see we're continuing to move further down that scale, not at the same rate. And the reason why is there was a growing increase of COVID cases, and right now there is a declining. So that will put us in a better position versus where we were in 2020. So that's when you start looking towards where we were in 2019. And the problem is when you look at where 2019 demand was, it was very elevated versus where we are today. But again, 19 was a bit elevated in general, so I wouldn't use that. That's why we always talk about 17, 18, 19, because 19 is a little bit too far out of reach and was stronger versus where we were in 16, 17, and 18. So just using, again, looking at it and trying to be more realistic on the different mixes and looking at the bearish and bullish side of it. Then when we look at propylene, we had a draw of 590,000 barrels with 18.8 million below the 5-year average. And the bigger issue is we're starting to cap out at a record low number as we have a record high amount of demand, which is putting us in a very interesting position as we come into the winter months, and will put more pressure not only on margins for chems when you think about running feedstock, but it'll also put more pressure on that heating side that we've been talking about because propane is used in such. And here you can see that we're still well below on days of supply. Given this recent draw and where the demand is, we're going to continue to see this remain a big overhang, and days of supply are just going to be well below where they're supposed to be this time of year. Vaccination rates continue to increase in Asia, again, net positive for underlying demand and kind of getting some of that normalcy back. And then when you look at vaccinations in general, you can see that we're still, progressing the right way kind of down that path. On the jet fuel side, we had an overshoot to the upside. Now we have an overshoot to the downside. We continue to say that we're just going to be at about that 1.4 to 1.5 million barrels a day of demand, which is, again, just going to move that sideways. It'll have this elevated level, but when you average it out, that's where we're going to continue to see with a small build of just 120,000 barrels a day into jet. And then when you look at global departures, you can see that rest of world is flatlining for the most part. Asia Pacific is flatlining, with Europe declining slightly, and then the U.S. kind of normalizing here. But we'll start to see some of those declines as we've seen with Southwestern, with the sick out, and now some talk of a pilot strike regarding the vaccine mandate. The average number of departures per day increased by 0.3% week on week. But then when you look at the global, on the global side, the passenger flight schedule for the 11 weeks ahead declined by 0.1% since last week. So you're still seeing essentially departures getting pulled as we progress through 11 weeks out, which is going into not only just November obviously, but into December and into January. Just looking at where some of those declines will come through. And then when you look at passenger, we're just moving with that seasonal bounce in 2019. You can see that we get a slow increase, then a decline, and then a spike into Thanksgiving, and just continues to move just below average, just below that 2019 level, where our highs are coming into 2019 lows, but we still are about this recent reading is about just about 800,000 people below, and that's where we think things kind of sit in general, of about 800,000 below in general. And then when you look at open table, you're starting to see some slowdown accelerating on the weekdays. Just looking at kind of what are the mobility, what are things doing. We still believe that will be about 0 to 5% better on the weekdays, and then about 10 to 15% worse on the weekends, which continues to play out overall. Now, in the next segment, we're going to look more at what's happening on the refining side, what is happening on some of these other areas as we go through the remainder of really October, because we want to look at where some of the flows are going, what is happening in the physical market. There's some additional negative data coming out when we look at West Africa, and we'll talk about that as we progress through segment 3.